how to read financial statements like an investor. In case you are investing your money in the stock market or even any other investment anchored on a given company, it is important for you to know how to read financial statements. Even if you are a beginner, by the end of this video, you really understand the kind of matrices that investors look at as they are deciding how to invest in a company. And by the way, it is important for you to know how to read financial statements. And that's so because a number of investors out there do push their money to the stock market without really understanding the business behind it. As I always say in my videos, do invest in the business. Don't just buy a ticket and assume you'll be able to build wealth in case you don't understand the business. And the easiest way of you diagnosing to have a sense of business health and even know the key metrics to be looking at is you going through the financial statements. In case you are new here, my name is Afagza Sifuna. I am a finance expert and qualified accountant, bringing you amazing videos daily on investing and making money. In case those are the kind of topics which you like, down there is a button called subscribe. Click that button to subscribe to my channel so that you don't miss out on any of the videos I upload each and every day. And while you still at it, drop a like on this video. Thank you for subscribing and also liking this video. Let me ask you a simple question as we start. Anytime you go to the hospital, right, before a doctor sees you and even prescribes any medication for you, you typically go through triage. They assess your symptoms, right? They even go and do relevant tests before you are given medication, right? So you putting your money in the stock market is basically you committing to a given medication. Why are you committing without knowing the symptoms of the underlying business? That is what the financial statement is going to tell you. And today, I want us to look at 3 key financial statements. The first statement is called the income statement or profit and loss statement. The second one is called the balance sheet or the statement of financial position. And then the third statement is the cash flow statement. These 3 statements are typically published annually by companies. Most of the companies listed at the stock exchange, in Kenya specifically, it is the Nairobi Securities Exchange. All these companies are required to publish their annual reports at the end of their financial year. And through that, you as a potential investor, you can be able to look at these statements and try to make sense of what each of these statements mean. So grab your paper and pen because I really want us to look at this in details. And even on my end too, I'm referring to my notes because I won't just be telling you about these statements. I'll actually be giving you a relevant example. And the example I'm going to be using today is the recent financial statements of a company called Safaricom, which is the biggest company when it comes to profitability in East and Central of Africa. And it is listed at the Nairobi Securities Exchange under the telecommunications sector. And with that, we have 3 statements which I've spoken about, okay? Let me tell you overview what they typically do. Income statement shows you how much money the company earned for that particular period under consideration. Remember, the income statement looks at a period, right? For example, for financial year, starting this date to this end date, right? So it is that entire period. So it shows you how much money the company earned. Secondly, it shows you all the expenses related to that particular company. Third, it shows you whether it made a profit or loss. Because remember, a loss or a profit is determined by taking the monies earned, okay, revenues, and then subtracting the expenses. You get to the profit. Of course, profit before tax, then you impose tax. It can become profit after tax before even imposing other things. But income statement shows you whether a company made a profit or a loss. And as I've said, it covers a specific period, whether it is 1 year or 6 months. Is that particular period block when we can assess these factors relating to a given company. And then the second statement is the balance sheet. The balance sheet shows you what the company owns, simply assets of a company, okay? Secondly, it shows you what the company owes. Now that's outward facing. Simply the liabilities and debts in relation to a given company. Then the third thing that the balance sheet shows you is how much belongs to shareholders. Under the balance sheet or the statement of financial position is normally called shareholders' equity. Simply how much belongs to the shareholders. And when you look at the balance sheet or the statement of financial position, think of it as a financial snapshot at a given specific point in time. That is why the balance sheet is normally prepared as at. It is not for a given period. Look at it this way. In case you walk to the company today, right? What is the financial snapshot as at the time you are walking in? Because when you walk in today, they give you the statement on the assets, the figures of the debts, and the shareholders' equity. In case you come 1 month later, it might have changed. Maybe they'll have borrowed more, okay? So the financial snapshot needs to be as at a given point in time. And that is what the balance sheet looks at. And then the third financial statement is the cash flow statement. The cash flow statement typically shows where the cash came from, okay? It typically also shows where the cash went, right? And it reveals whether profits are backed by actual cash. And that is an important thing for you to really understand. If a company, for example, is making profit and it isn't backed by cash, that could be a red flag. Are they cooking their figures, okay? Because all these three statements work in tandem to assist you wrap your head around the financial health of any business. Let's now delve in to look at each of them individually. And even with this, I'm going to give you a relevant example looking at the numbers of a company called Safaricom. Of course, broadly, Safaricom has been doing very well, right? It's been experiencing share price appreciation in the stock market, and also it did pay dividend last year, meaning the company is doing very well, and there's increased confidence in the company by the shareholders. So that's it in summary. But then again, what exactly do the income statements say in case you want to invest today? So starting with the first statement, which is the income statement, right? Income statement, as I said, first and foremost, it looks at revenue. Simply, is revenue increasing every year? Okay? Is the company selling more product or services? In this context, Safaricom, of course, we know the product offers. There is the airtime, there is M-Pesa, right? There is the data, there is business enterprise solutions. So all those could fall under products and services. And the third thing relating to revenue is that the consistent revenue growth usually signals demand. Now looking at the Safaricom statement of the income statement, I'm just opening it, right? Statement of profit or loss, which is the income statement. I'm referring to the statement for the year ended 31st March 2026. When you look at the total revenues, right? Safaricom revenues, as you can see, were 427 billion Kenya shillings. And that was an increase from 388 billion Kenya shillings from 2025. That tells you the revenue trajectory is on the upward trajectory. And of course, under revenue, you can see the specific things, right? Like, for example, the direct costs. You can see, for example, the expected credit or loss on financial assets and other operating expenses. You can see in snapshot, the revenue of Safaricom increased. That tells you year on year, the revenue looked good, okay? Now the second thing which the income statement looks at, it looks at operating profit. Operating profit is simply when you take the revenues, right? And then you remove, right, cost of goods sold or even so cost of doing business, you're going to get a profit. But then in that profit, you need to be careful, for example, for you need to ignore any once-off gains. Because at those moments, for example, where even a company might sell some of its asset, right? And that might signal a bump in profit, but in reality, that is a once-off. So if you're making a decision, typically ignore the once-off gains, right? But just focus on the recurring operations and also what the revenues were. When you do that particular math, it's going to give you the operating profits, okay? When we look at the statement of Safaricom, basically here, we're looking at the operating profit, which is simply the earnings before interest and tax. You know, EBIT, when you look at the figures last year, Safaricom, as of 31st for year ending 31st March, their operating profit was 146 billion, up from 104 billion from 2025. That tells you the operating profit of Safaricom has increased, which is a good indicator. But then again, let's go back a bit and look at the earnings before interest and tax and depreciation. When you look at it very well, we are not seeing any once-off sales. So that tells you Safaricom was able to surge its operating profit based on the core business. There wasn't, like, for example, a once-off sale which bumped up the figures. And that is a very good thing, right? Because it increased its income based on its core business, right? And then the third thing which the income statement tells us is that we need to look at the net profit, right? And the net profit is basically what the company made after removing now everything, okay? After removing everything there, we can tell is the profit growing over time. Then we can compare over several years, and a steady profit growth is generally a positive sign. So looking at, for example, the profit of Safaricom, right? When you look at the profit for the year, simply put, after tax and so forth, the profit for the year for Safaricom was 73 billion Kenya shillings, right? That was an increase from 45 billion Kenya shillings. This, of course, is profit after everything you've deducted. That is a very good sign because it tells us clearly the profit of Safaricom Group did bump up. And even when I look at it, it was a bump up of even upwards of 30%, which is a very, very amazing indicator if you look at it, comparing the 2 years. And now you as an investor, in case you go a longer time frame, even look, for example, for 3 years, 4 years, in case the profit is consistently increasing, that tells you it is an amazing progress by a company. But also, as you're looking at the incomes, also examine, are the costs rising? Because if the costs are rising very fast compared to the income increase, it might tell you, assuming you forecast, then you might get in trouble of profit decreasing in case the costs are rising very rapidly. But when you look at Safaricom statement, it looks good because, in fact, it is maintaining its operating costs around the same margin year in, year out. And even on some of the items here, I can see the operating costs actually did decrease, which is something amazing, right? Because I can see 2024, 2023, operating costs were about 104 billion. 2026, the operating costs were 98 billion. That is a good sign, meaning it is actually managing its operating costs even as it continues looking to surge up its net profit. Guys, that is an example of how you look at the income statement. And now factoring all these things together, one thing you should need to take away is that revenue by itself is vanity. Net profit is the reality of how our business is doing, because revenue could look like it is big, but what if the operating costs are also increasing? That's why, yes, look at the trend on revenue, but most importantly, look at the trend on profit for you to be able to know if the company is truly profitable year in, year out. Okay? And now with that, let's move to the second statement. And the second statement is the balance sheet or the statement of financial position. Remember, I said this is a financial snapshot at a given point in time. Now for Safaricom specifically, remember the income statement was for a period ending, for 1 year ending 31st of March. But now the financial position statement or the balance sheet is as at that particular 31st of March of 2026. And for you to be able to read the balance sheet like a detective, there are some key things you need to be looking at. Gain understanding on the assets, gain understanding on the liabilities, understanding of shareholders' equity. And under assets, you'll be very keen to understand cash, okay? Does the business have cash? The buildings, okay? Equipment, right? Typically, in manufacturing, for example, it's called property, plant, and equipment. Understand investments, understand inventory, okay? Growing assets can indicate expansion, but quality matters too as you are looking at expansion, because we've seen, for example, businesses which have expanded very fast, but they have ended up in losses. And then now under liabilities, you'll begin to understand does a company have debt? Simply, bank loans it has, existing supplier obligations, bonds, and even any other debts out there which the company has. Because by default, debt isn't always bad. But then again, excessive debt can become a problem. More so, if a company isn't able to meet its debt obligation, it can become bad debt, which is a very bad sign for any company which aims to be profitable. And of course, another third thing which I've spoken about is shareholders' equity. This simply represents what owners will theoretically have left after paying all their liabilities. A company that steadily builds equity is generally creating long-term value for shareholders. And having said that, when we look at exactly what is happening on the end of Safaricom, right? Looking at the statements, this is a statement of financial position for Safaricom as at 31st March 2026 at a given point in time, not for a period. When you look at the statement comparing 2025 and even 2026, 2026, non-current assets, these are, for example, deferred income tax, property, plant and equipment, rights of use, intangible assets like intellectual properties, right of use assets, investments in subsidiaries, you name it. All these came to a total of 438 billion, a bump up from 2025, because 2025, the non-current assets were 431, okay? And then, looking at the current assets are simply things like, for example, inventories, right? Trade and other receivables, net cash and cash equivalent, because also cash is very important, contract assets, restricted cash, and even mobile financial deposits. Total of current assets was 518 billion Kenya shillings, up from 515 billion shillings, which indicates the assets actually did grow year in, year out. Because when I look at it, combining both current and current assets, we can see there's an upward trend on the assets of Safaricom, okay? So the total assets, as I've said, were 518 billion. Current assets specifically was 79 billion Kenya shillings. That's an upward trend, which is amazing, okay? And then, when you take a look at equities, we can see total equity was 230 billion Kenya shillings, up from 224 billion Kenya shillings. This tells us in 1 year, Safaricom created more value for shareholders once you remove all the liabilities, which is an amazing thing. And talking about liabilities, one thing worth noting, when we combine both current liabilities and non-current liabilities of Safaricom, the liabilities did reduce, which is an exciting thing for any investor to note. And specifically, the point of drop of this I can check is, let me see. Perfect. You see payables and accrued expenses did reduce, which is an amazing thing. And also you saw some piecemeal reduction across different areas, which brought both current liabilities and non-current liabilities to a total of 135 billion Kenya shillings, down from 155 billion Kenya shillings in 2025. That tells you a particular momentum where assets are increasing, liabilities are reducing. Safaricom was able to create more wealth for shareholders. That's why even we're seeing, for example, a bump up in shareholders' equity, which is an amazing thing. So looking at all these, when you look at total equity and liabilities, as we can see, there was a bump up of about 3 billion Kenya shillings year-on-year increase, 2026 compared to 2025. Guys, that is how you look at the statement of financial position or the balance sheet of a company, because it shows you its asset health, how it's behaving when it comes to assets, its obligations, and for example, debts running away and so forth. And talking about debt, please emphasize on checking debt level. And I'm saying so because many businesses don't fail because they lack customers. They do fail because they owe too much money. And if they owe too much money, they'll end up affecting their main operations. The questions you need to be asking yourself are, is debt increasing every year? Can profits comfortably cover interest payments? And then the third question is debt growing faster than revenue? In case debt is growing faster than revenue, the profits can't cover interest, then that is a red flag, because that company is bound to get in trouble, okay? Now, let's look at the third and final financial statement, which is the cash flow statement. The cash flow statement typically has three things: operating cash flow, investing cash flow, and financing cash flow. The cash flow statement is a statement which typically beginners out there skip, and experienced investors don't skip because they know it means something to them when it comes to their investment. Because operating cash flow tells you, is the business generating cash from normal operations, or where is it generating cash from? Okay, because ideally it needs to be generating cash from the normal operations. The second thing operating cash flow tell you is positive operating cash flow is generally a good sign, right? Because if it's generating cash flow and is on a positive side, that is a good sign. And then look at, for example, now investing cash flows, right? Under investing cash flows, it tells you, is the company buying equipment or even expanding? Because also, most of if a company is a growth company, beyond just balancing between profit and also balancing dividends and so forth, you'd also want to say that the company is really investing in growing. So investing cash flows do tell you, is the company buying equipment or expanding? And secondly, large investments aren't necessarily bad if they support future growth. And to give you an example, a few years ago, we saw, for example, Safaricom invest hugely in expanding to Ethiopia. Even some analysts out there thought it could be troublesome to Safaricom. But Safaricom, that huge investment has been yielding profit in recent years. Okay? And then the third thing, which cash flow statement look at, is financing cash flows. Simply put, is the company borrowing heavily? Because upon borrowing, the cash are gonna inflow to the company, and you can tell through the cash flow statement. Secondly, is it paying back debts or is it defaulting? Then third, is it paying dividends? Because from the cash flow statement, you can tell if a company is paying dividend and even compare year on year, have the dividend payment increased? Talking about that, let's now look at exactly how Safaricom fared across these three areas when it comes to the cash flow statements, right? So when I look at the cash flow statements of Safaricom, cash flow from operating activities, the cash flows did increase in the year 2026 because the net cash flow generated from operating activities were 169 billion Kenya shillings, up from 137 billion Kenya shillings. And specifically, these were driven from cash generated from operations. Simply put, Safaricom made more money from its core business. Remember, the core business of Safaricom is what? Airtime, data, M-Pesa, and business services solutions. So that's a good sign, meaning it was able to generate more income from its typical operations. Then when you look at the second thing, cash flows from investors' activities, right? When you look at investors' activities, simply put, are Safaricom investing? Simply, these are investing cash flows. When you look at investing cash flows, Safaricom did invest more in the year 2026 compared to 2025 for the year ending 31st March 2026. And when you look at exactly what Safaricom did, for example, purchase of property, plant, and equipment, we can see it did bump up its investment in property and equipment by 20 billion Kenya shillings, because it increased from 60 billion in the year 2025 to 80 billion in the year 2026. That by itself is a good pointer for any investor out there, because a savvy investor now will want to go to the notes to see exactly which property and equipment Safaricom did purchase, right? Of course, in the interest of time, I won't really delve into that, but below any financial positions, we normally have notes. Such kind of nuance here, we've seen like a more increase in 20 billion in it investing in property and equipment. Notes will tell you exactly where the investment went and which equipment were bought for which country and so forth, okay? So based on that, there was an increase in investing activities cash flow, where it was now 99 billion, up from 75 billion in 2025. This hopefully is geared towards Safaricom being able to generate more cash flows because it's invested in its ability to generate more cash flows by investing in property and equipment, okay? Another thing now we need to look at is cash flows from financing activities. And this is also another point which is critical because it speaks about debts and even the company's cash flow relating to dividends. So looking at Safaricom, we can see the cash flows from financing activities did increase in the year 2026 compared to 31st March of 2025. And when you dig deeper, we can see, for example, dividends increased to 60 billion, up from 53 billion in 2025, right? Other areas of increase were, for example, proceeds from borrowing. This is important to note. Proceeds from borrowing, which also are commensurate with repayments of borrowing, did increase. Repayments as of 2025 were 26 billion. In 2026, it was 74 billion. That is an increase of almost 50 billion, right? That by itself is not a bad thing. Remember, I said you need to check also and compare with the income statement. Simply put, are the profits of the company able to cater for the interest of the borrowing? If they're not able to cater for the interest, it is a problem. But if they are able to cater for it, then it is healthy. In this context, the bump up in borrowing, we're talking about Safaricom repayment of borrowing being 74 billion Kenya shillings, right? The interest portion of that is about 10 billion, right? Kenya shillings, which I think can easily be accommodated through the net profit. So there's no cause for alarm, okay? And this tells you that generally the income statement, the balance sheet or statement of financial position, and cash flow statement of Safaricom generally looked good. That, guys, is an example of how you look at financial statements of any company out there and try to deduce the company health. Because if some of the indicators we are looking at were quite off, then that could be a bad stock to invest in, or even in case you'd already invested in that particular stock, you might need to rethink your position. And beyond just looking at the absolute figures in the financial statements, there are key numbers which investors typically look at out there. Just in summary, you don't need to memorize these ratios, but in summary, they are very useful. As I've spoken about, revenue growth is sales growing consistently. And as we're looking at revenue growth, most important metric is profit. Then the second thing is net profit growth, right? Are earnings increasing over time? Because revenue could be increasing, but earnings are not increasing. And yet you as an investor, you are very keen on net profit growth, okay? The third thing is free cash flows. The free cash flows tell you, is the company generating cash after necessary investments? Case in point, you see, for example, Safaricom did bump up its operating cash flows, which is amazing because it tells us that they are generating more cash flows following their investment year in, year out, okay? Then the fourth thing you need to be looking at is debt to equity ratio. Debt to equity ratio simply tells you, does the company rely heavily on borrowing? Because if it's relying heavily on borrowing, then it might have an unhealthy ratio. And then the fifth thing is earnings per share. Simply put, is each share becoming more valuable? Because ideally, a company should be generating more and more profit year in, year out compared to each of the shares which is out there in the market. So when you see EPS increasing, it is a good indicator. But if EPS is decreasing, then there's some cause to be worried, okay? And these 5 metrics provide a solid first impression of a company to any investor out there. So just ensure you look at these, and that is how you look at the financial statements for you to deduce if a company is healthy or not. And of course, as I've said, beyond just looking at 1 year, try and compare. How is it 2 years? How has it been 5 years? Okay? And if possible, you are really invested in the analysis. How has the trend been over 10 years? That will really assist you shape your mind around the trends around consistency of revenue, around improving profits, stable or declining debt, increase in cash flows, and even growing shareholders' equity for you to decide if to invest or even to alter your position. And as I conclude, remember a point I told you. Don't just look at the absolute figures in the financial statements. Simply put the income statement, balance sheet, and cash flow statement. Also look at the notes, because the notes have the explainers. Notes typically explain what is happening in the financial statements. Most beginners ignore notes. Investors know very well they need to be looking at the notes, because notes are going to tell you the accounting policies used, right? They're going to tell you any major risks you need to be aware of. Notes are going to tell you any pending lawsuits, right? Are they, for example, paying legal fee? They're paying for what exactly? Notes are going to tell you significant loans which the company has. Notes are also going to tell you any related party transactions. And most importantly, any change in accounting methods. Because a change in accounting method could make all these figures change. Maybe a profit can even increase because of a change in accounting method, right? Maybe moving from accrual to another method. So you reading the notes is going to assist you understand these nuances so as to wrap your head around everything that's happening to a company. Guys, that is how you read financial statements. What do you think about this video? I hope you've gotten a thing or two on how to go about reading financial statements. And by the way, in case you want one-to-one advisory or coaching, I am available to listen to you, to understand your investment goals, and together discuss what a possible cause for you would look like. Each and every day, I spare about 3 to 4 hours to be able to assist with one-to-one coaching and mentorship. So my number is down below, my WhatsApp number. Hit me up on WhatsApp and book your session. Please note, I'm doing this at a very favorable rate. Hit me up, let's plan, and then catch up. We're going to go through everything relating to your investment for you to know how to improve your position. I hope you've gotten a thing or two from this video, guys. Look forward to catching up with you in the next video. Cheers, and you all stay safe.